Hello everyone and welcome to your Glassnode Onchain report for week 26, 2022. Now we are going to try and assess a very big question, which quite frankly there is no actual answer for. We really have to see how this plays out, but this is this time different? We're going to look at Bitcoin across a number of metrics from cyclical to hodler-based metrics to market structure, a lot of which have deviated a very significant distance from what we call the mean, or essentially they are what we call out of bounds. They've moved beyond what we would call an extreme level, or they're sitting at an extreme level. Now, of course, markets can do whatever they want. They're a variable, challenging beast. So what we're going to try and do is just assess the data as it stands in front of us and try and answer the question as to whether this time is in fact different and what the data is telling us about Bitcoin market structure. So when we look across a number of macro indicators, these are these very big picture, cyclical, almost bull-bear deviations. When we look across this on a number of metrics, a lot of them are at all-time lows, which typically signifies we're at like the underside of these bear markets, what we typically see at the floors. And what we're trying to look at here is both on pricing models, cyclical oscillators, spending behaviors. Are we seeing what is coincident with previous bear market floors? Now that we're down at these levels, does the market structure actually resemble and look similar to previous cycles? Now remember that doesn't necessarily mean that things are going to play out that way, but we also have to use the data that we have available to really assess against what we've seen in the past, how investors have performed in the past, and really what we're coming back to here is that whilst markets are different and cycles are always different, which is where the meme comes from, it always feels different, human beings and the way that we respond typically is much the same. So again, it doesn't mean that things will play out this way, but what we're looking for is what is the investing cohort? What are the holders of these projects? What are we actually seeing in terms of their behavior on chain? That's really what we're trying to assess here, because quite often human beings are repeatable, even if the market cycle and the market structure is not. So before we get started, please do give us a subscribe and a review, and we are reading your comments, so please do keep them coming. Just as a bit of a heads up, we've also restructured the dashboard for this particular session. So if you do have any feedback, you'll find the link for the actual dashboard in the link below. Please do let me know if you enjoy a dashboard in this structure a little bit more. We've got text and try and guide you through. And I'm also going to start by just showing you a couple of the tutorial dashboards that we've recently released that anybody with a standard account will be able to see. So it's actually open to everybody. They're really to help you onboard into Glassnode. So let's really get started. So within dashboards, we recently released these tutorials, and there's 4 of them at the moment: navigating market tops and bottoms, introduction to on-chain activity, the fundamentals of Bitcoin mining, and an introduction to supply dynamics. Now, all of the charts that you'll find in these dashboards have descriptions to really help you navigate what's going on in each one. Each one has a video guide to help you actually explore these ideas and really get you up to speed with not only using Glassnode tools, but also coming to terms with how we use some of these things for our analysis. Now, every single chart that you find in these dashboards is going to be available to any standard user. So you actually don't need an advanced or a professional account to use these. And you'll also find that we've built a lot of these inside Workbench to show you how we use some tricks of the trade. So how we get these green and red backgrounds when certain conditions are met, for example, how we build oscillators, various tools to really help you use these. And as a quick tip, you can hit this little magnifying glass at the top here to actually load up any chart in Workbench, or in Studio, so you can actually see how we've built these charts. So do let me know in the comments as well whether you found these tutorials useful. We are looking at rolling out more to explore more concepts in on-chain, including advanced and even beyond in terms of the level of detail and content. So please, I do welcome your feedback, and it helps us really gauge content that's best suited for you. So getting started with our analysis this week, clearly we are still within this major downtrend, right? This has been in effect essentially since the November all-time high, and we really only had one period of a break, and we're starting to consolidate down here at the lows at the previous cycle all-time high of around 20,000. So 2022 has been a very challenging year, and we recently released 2 pieces, one on the Ethereum side on the deleveraging, and then one looking at Bitcoin. Both of these you'll also find in the description below. And these really capture just how significant 2022 has been. Arguably, when we look at it from a historical and a statistical standpoint, it's probably one of the worst bears that Bitcoin has ever seen. So we are in a historical moment. It is pretty grim. But again, this is kind of the beauty of having this data. We can really describe it in fairly intimate detail and really quantify and assess what is going on at any point in time. Now, Let's start with our analysis. We're going to look at things in terms of market structure, what's going on. We're just trying to let the data guide us in this session. So the accumulation trend score, as we've noted, this is a metric that really describes where the balances are changing. And we covered in the last few videos that this is being mostly driven by whales with more than 10,000 BTC and shrimps with less than 1. And this actually hasn't changed. This continues to this day. They are adding to their balance quite significantly on chain, whereas the rest of the cohorts, those 1 through to 10,000s, are fairly neutral. So you can see that we've had this period of very dark purple. This is returning scores greater than 0.9, which shows that those specific entities are adding meaningfully to their balance. Now, if we look at this on a 5-year time frame, you'll actually see that there's only a handful of times where we see this behavior. There was the November 2018, so at the bottom of the bear. There was also the rally that came out of it. There was the March 2020 event into the bear, and then the bull market that came out of it. Now, there's one kind of strange one, which is coming off the all-time high back here in November and December. The only way to describe this is people who were buying the dip and realizing it actually wasn't the dip. So this is almost a bit of an outlier over the last 5 years of history. And you can see here we are. Now, we don't know what the future holds. So we don't actually know whether it's going to be one of these events where it's actually looking more like a bear market bottom, or if it's one of these people stepped in and bought the dip a little bit too early. We actually don't know, but this is where we're going to try and flesh it out with the remaining models that we look at. So that's our context. We do have accumulation that's going on. It's specifically being driven by whales and shrimp, which is a very interesting dynamic. It's kind of the two sides of the bell curve, and everybody in the middle seems quite cautious, or at least neutral. So the first piece of our analysis we're going to look at is Bitcoin bear market floor models. Now, remember, models are simply that. They do not predict the future, but what we're looking for is confluence. And you'll see that we're going to weave statistics all through this to try and bolster the argument. So there's 5 models on this chart. The first one is the Mayer multiple in red. Now, this is when price is trading at a 40% discount to the Mayer multiple. And at the moment, if you look at all of Bitcoin's trading history, only 3.4% of all trading days has the price been below this level. So we're essentially looking at when price is deviated below the 200-day moving average by a very, very large amount, and only 3.4% of all days. So it's statistically unlikely for price to be down here. However, we are currently sitting below the Mayer multiple of 0.6. We're sitting below the realized price in yellow, which captures 14% of all trading days. We're below the 200-week moving average, which has only been below for 1% of all trading days. So at the moment, we've got a 3.4%, a 14%, and a 1% that we're currently trading below. Now, when we combine those, that's what these blue vertical lines are showing. Periods of time where price has been underneath the Mayer multiple of 0.6 and the realized price and the 200-week moving average. And it might amaze you that they've only been in this circumstance for 13 days in all of Bitcoin's 4,361 days of trading history, or 0.2% of all trading days, we have been below this level. So again, that doesn't mean that it is the bottom, but what we're looking for here is that models that have previously coincided, you can see they tend to cluster around these bear market floors. They were below through most of 2018, and then we really entered that zone during the late stage. March 2020 dipped into it, and here we are dipping into it again. So there's 2 levels below this. There's the balanced price, which is an on-chain model, which is really capturing the price paid versus the price spent. This is one of these very long-term OG models that's been around in the on-chain space for a long time by Dave Puel, and only 3% of trading days have ever been below this. And then the last line of defense that we have is the delta price, which is the difference between the realized price and the all-time average. Now, on a closing basis, this price in purple has never been breached. So we have never seen the Bitcoin price close at the end of a day below the delta price. Now, of course, what we're trying to assess in this session is this time different? And of course, people can say we've broken below the all-time high. That's different. We can look at the macro scenario and say that's different. What we're looking at here is that the price is currently sitting inside a cluster of these models that have historically coalesced around lows, And what we're trying to do is really assess if we were to continue trading lower or continue trading higher, what does that tell us? Does that help us answer this question of, is this time different? Or are we actually within typical historical means and normal levels for this part of the cycle? So this is just an interesting way we can combine all of these different models. And as I said, these blue lines are showing when we have the exact same circumstance to right now, below those three models. So now we're going to transition and look at a couple of long-term macro oscillators. These are typically capturing hodler behavior alongside price. So the reserve risk is one of these ones that will be weighed down heavily when there's hodling going on. So price is in the numerator, and the denominator of this ratio is essentially the amount of hodling. When there's lots of coin day accumulation and people are putting coins in cold storage, this will get weighed down heavily. And we are essentially breaking to all-time lows right now. So there is a lot of hodling going on. It's signaling that the hodlers are still there and they're fairly unshaken, which remains impressive. And I will say, rightly or wrongly, just because there's hodling going on doesn't mean they've got enough buy side to put that floor in. But it's telling us something about their conviction and their strength in the market. So they don't particularly care, rightly or wrongly, that price is now down substantially from the all-time high. Now, the dormancy flow is also broken to an all-time low. We can reasonably discount this 2011 data because it is so early. I typically will discount that because it's just Bitcoin was a very different beast back then. So on an effective basis, we are now at an all-time low. And what you can see here, whereas the reserve risk is mapping price to the hodling behavior, dormancy flow is mapping it to the spending behavior of those hodlers. So when we've got lots of these older coins coming back into the mix, it's going to drag it down, and so will price. Now, at the moment, we have what spending is going on is pulling it down, and you can see actually that the low, this all-time high here in November, here's a good trick for next cycle. Note how during the February, April, May peak, we had a high in the dormancy flow. But note how we had a much smaller high on the November-October rally. The reason why is because lots of hodlers were spending on the way up. So the price was high, but the spending was heavier. So this is what we would call a bearish divergence. And what you'll see is that dormancy flow typically starts to recover after the late stage capitulation. Why? Because that's when hodlers stop their spending and reverse their behavior. So this is a good metric to pay attention to. Even though we've broken down to all-time lows, start watching for that reversal, which is essentially going to signal that price is getting cheaper relative to the amount of hodler spending. So a recovery in this metric is a good sign. And we see that this typically breaks lower as we come down to these capitulation zones. Now, there's one more thing I'll highlight. Note how we have a descending value in all of these upper bounds. This is just describing the changing hodling behavior. Over time, we have institutional products, we have derivatives. The market evolves over time, so the hodling and spending behavior also evolves. And we typically see that many of these metrics descend in their peaks over time. It doesn't mean that the metric is losing signal. It means that we as analysts must appreciate these changes that are going on and adjust accordingly. So that's why it's having the same level all the time. It does require a little bit of thought process, which is really what these guidance notes on the side are trying to provide, that context so you can really use these tools to their maximum use. Now, the last one we're going to look at in terms of the overall cyclicality is the RHODL ratio. So RHODL captures the balance of wealth, coin wealth in USD terms, that's held by 1-year-old supply, 1 to 2 years, and 1 week-old supply. So if I describe Bitcoin market cycles, up here in this red zone or these topping zones, this is where we have a very, very large proportion of the wealth held by brand new buyers. Literally, the older hands have spent their wealth, they've sold into profit, and new buyers who've come in because the media and their friends getting rich and all of this exciting stuff at the top of bull markets, they've oversaturated the coin supply. Then we go into a bear market, and this metric will decline. This is showing a wealth transfer, which takes time. It's gradual. It's a process. Wealth transfers from those new buyers who speculate and they go, that's it. I have to get out of this market. I'm tired of losing money. And the smart money slowly accumulate those coins. And the wealth transfers back to those 1 to 2 year old hodlers. Now, 1 to 2 years in Bitcoin is like an age for everybody else. You see volatility, you need seriously high conviction to stick around for 1 to 2 years. And that's why this metric typically cycles between these extreme highs, saturation of new buyers, and extreme lows, a saturation of older buyers. And note that this metric is also both on the top and the bottom starting to compress. So again, we have to kind of adjust our levels and really assess where this is going. What we're looking for here is these transitions, these bottoming phases, when we're starting to get that maximization, full saturation of 1 to 2 year holders. So now discussing a little bit about market structure, really what's going on under the hood, what's it telling us about the recovery and where this market cycle is at. So you'll see me talk about on-chain activity quite a bit, and that's why there's a tutorial based on this. I think it's a really important and undervalued part of on-chain analytics. What I have here is active addresses, and I've just established a very simple line that shows that when we're in this bear market channel, you'll find this in the actual written report, you can see the bull markets when you get these explosions in activity, right? It's clear as day. This is the bull, and then we descend into this sideways to slow grind higher. This is the recovery phase of the bear. So we had our 2020 into 2021 bull. We had our collapse in May. We had a brief poke up again like 2019 here in this October, November, and we've really been grinding sideways. So what this is truly confirming is that we have most of the hodlers are the only ones who remain. They don't really have reinforcements coming in at this point in time. It's only the hodlers, and we really, price is correcting until the supply that's being sold is going to match that hodler demand. It is consistent. They seem to be the same people who've been here for some time. They don't have reinforcements, but this is the nature of bear markets. This is how these cycles tend to play out. It's a gradual process. Wealth transfers from those new speculators back towards the older, smarter people who are willing to go through the volatility and the pain. They're folks, those hodlers of last resort, who are essentially here rain, hail, or shine, and price is correcting until it finds that demand level. Now, in terms of percent supply and profit, you'll see us talk about this quite a bit. We're really trying to assess the financial pain in this market. Now, in the newsletter, I would recommend that you go and read this section. What we look at is a case study. You can see here that previous bear markets have bottomed around 40 to 45% of supply and profit, meaning that more than half of all coins are underwater. You can see here in 2018 and March 2020 dipped its toe right below that level. Now, during the sell-off to 17.6K last week, we did in fact get down below 50%, but it was obviously very brief. We more or less rebounded over the weekend up to 20,000. Now, during that process, about 1.5 million coins were distributed between 16,000 and 20,000. So a bunch of coins were sold in capitulation, new buyers came in and bought those, and if we actually model out a scenario, what would happen if we drop from this 50% level down to 45 or 40? Well, price would have to go back down and retest that 17,600 level, and we would actually be back down into this zone that has put in the bottom in previous bears. Now, again, this doesn't mean that this will happen, but it's trying to gauge when we're getting these historical similarities to previous bears. So there's another metric. We're just kind of assessing what could happen if we get that sell-off down to 17.6. It would effectively show that we're at the same level of profitability as the 2018, the 2015, the 2012, and March 2020. All of these bears would be very, very similar. So we're looking for that similarity in a historical context. And here's our aSOPR metric. This one is modeling out the average profit or loss. If it's profit, it's above 1. If it's loss, it's below 1, being realized by the overall market. So when it's trading down below 1, see these periods of the bear 2018, it kind of oscillates between profit and loss as we get these bear market rallies. People sell the top and then they capitulate. They sell the top, they capitulate. So it's a period of extended pain. The same here in 2019, extended pain into the final capitulation. A major sell-off event where the amount of losses realized spiked through the roof. Here's 2019. We had this period of oscillation into the March 2020 capitulation event. In our current cycle, we had our first shock wave in May, June, July. We had a bit of a recovery. We re-entered that pain zone, and then we had our capitulation. So there is a very similar market structure in terms of the way that investors are behaving to previous cycles. You can see here that history doesn't repeat, but it certainly rhymes. We have very, very similar behaviors playing out, even if there's a slightly different structure. And this is where, as analysts, you need to be flexible to really understand what's going on and use all of the information at your disposal. So the last thing that I want to touch on is supply dynamics. So we mentioned in some of the sections above that more or less the hodlers appear relatively unshaken. Now, this doesn't apply to everyone. There's going to be some long-term holders that are selling their coins. So in the newsletter, we dive into this in more detail, but what we essentially captured is that 181,000 BTC was sold by long-term holders in June. So that's a lot. It's quite significant. It's about 7% of the coins that they added to their balance in the 2021 cycle. So what I tried to assess is, who are these long-term holders? Are we seeing people from 5 years ago finally realizing that Bitcoin's going to zero? Or is it people from this 2020-21 cycle who are essentially capitulating after being underwater for so long? And these are two different theses. If you have people from previous cycles really exiting the system, that's showing a loss of conviction. It's not a great sign. That would be a very negative sign. If, on the other hand, most of the sell side is coming from people within this current cycle, that's going to tell us that it's probably a classic capitulation. It looks like previous bears, and thus maybe isn't that different overall. So what we're going to look at here, this is the supply older than 6 months. This is a workbench chart that this is the metric of the week. So if you do want to expand it, you'll see up here, view in workbench, you can see how this is constructed. Now, what we see here is that coins that are older than 6 months had a bit of a dip. It wasn't quite 181,000, which is coming from the long-term holders. That's 5 months. But we can see that there's about 168,000. So when we compare these numbers, how many coins of that long-term holder supply that was spent were 5 to 6 months? How many was 6 months to 12 months? And how many were 2 years plus? We're looking at these 3 different age brackets to try and assess, where did these coins come from? And what we can actually see is that there's not that much coming from the 5 to 6 months type arrangement. People who've bought their coins in the last 5 to 6 months were only contributing about 7% of the sell side. But when we look at our 1 year supply, 1 year supply actually contracted quite substantially. Let's zoom this in. Actually, let's go on a 3-year basis, 2-year basis. So more than 1 year coins actually contributed about 82%. So a very significant portion came from coins that were 1 year older. So then we look at our 2-year supply, 2 years and older. Notice how it's pretty much flat since April. What that's essentially saying is that coins that are older than 2 years didn't really contribute at all to the long-term holder spending. Therefore, the coins that were spent, this 180,000 BTC spent by long-term holders, was not older than 2 years, more or less. It was mostly older than 6 months, which therefore puts the range of coins that were being spent between 6 months and 2 years. And when we map that out, that's essentially this left side of the chart. We're seeing 2020 all the way through to 2021. This is where most of the spenders are coming from. They are people who are spending from this cycle. We're not seeing people from previous cycles capitulating. We're seeing folks who bought their coins much higher, capitulating at a loss. Overall, what we're seeing is a classic capitulation. Long-term holders, about 181,000 coins are being spent. What is important to pay attention to, if you're looking for 2 metrics to be paying attention to, the first one, 1 year supply. If this continues to deteriorate, this is showing that we continue to lose conviction. If the 2 year starts to decline, that's showing an even greater loss of conviction. That's showing that people from previous cycles are losing their conviction. And then we have our 6 months. So you can really assess what's going on 6 months and older, 1 year and older, and 2 year and older. And you can deduce from those where those spenders are coming from. So thanks for tuning in for this session. Hopefully you found it useful. Please do give me some feedback on if you found this dashboard layout more convenient. As you go through and actually look at the descriptions, let me know if it helps actually having the guidance with these charts. And also check out our tutorial dashboards. I do hope that you find those useful. They're really designed to help people get a hands-on experience with Glassnode if you haven't used it before. As I mentioned, all of those charts are available for anybody with a Glassnode account. You don't even need to be advanced or pro. What we're looking for is to get people more hands-on, trying out the tools, and I do look forward to hearing your feedback. So until the next video, I'll see you then. Cheers.